So we'll start from this problem. So this problem deals with flexible budgeting. We'll read the question required. So the required is, using a flexed budgeting approach, redraft the operating statement so as to provide a more realistic indication of variances. Explain why the original operating statement was of little use to the management. So they have given us some data and we have to redraft it in terms of a flexible budgeting, and we have to work out. So we have already seen in the theory video that flexible budgeting refers to conversion of the budget units into actual units terms, but the amount per unit should be in terms of the budget. So we have to work out this problem and see how flexible budgeting works. So as usual, we'll start from particulars. So we have to find out the flexible budget, the actual, and also the budget. So we'll start from units, sales, then in terms of then cost of sales, that's split into variable cost and fixed cost. We'll get gross profit. So we don't need to work out in gross profit terms because that again goes to kind of financial accounting terms. What we'll do is we can work out in terms of marginal costing statement. So what we could do is, first we can have all the variable cost, then we can have the fixed costs. I think that would work well. So then we have selling and distribution cost, selling and distribution cost. So again, that's going to be variable. We also have a fixed element in that. Then we have admin cost. So I think we have got all the cost here. So how does this work? So first we'll get the units, 640, then 720 here. So what would be the flexible budget units? The flexible would be similar to the actual because we have to compare these two only. So let's get the sales, 1024, 440, then 100 here. So selling fixed is 72 and administration is 184. Selling and distribution variable is 144. And administration cost variable is 48. So we got all the numbers here. So we'll also get fit for the actual because we have to compare it. 1071 is the actual sales. Cost of sales variable is 468. Selling and distribution variable is 153. Administration variable is 54. Fixed cost of sales is 94. Selling and distribution fixed is 83. Administration cost fixed is 176. So now we have to get the flexible numbers. So how do we work out the flexible numbers? We have to do calculation. So we'll do the calculation here itself. We don't need to do in a separate place. So to do a calculation, it works like this. It's going to be sales amount is 1024, but this is even for 640 units. But we want it for 730 units, right? So that's what we want. So rather than putting it as 1024, we can get this number. So divided by 640 into 730. Let's get the number. So this is how it works. So the same concept, we just copy it and we paste it for all the variables. So it would be 440 here, 144 here, and 48 here. You can copy all of them. So for 640 units, it was 440. For 720 units, it should be 501. The same logic applies for all the other numbers here as well. And if you take fixed cost will not change. It will be the same number. So we can just directly put it here. We can get the contribution. Okay, so we can get the contribution. The contribution would be the sales number minus all these numbers. So it's 447. So again, what would be the profit? The profit would be this number minus okay, so profit is 91.25. That it should have been 91.25. So let's get the answer for the actual. The contribution should have been 396. It should have been 447, and profit should have been 91, but it's only 43. So where is the problem hiding? So that is what we have to find. See, the problem is in terms of the variance. So variance is the difference. See, it should have been this number, but it is this number. So 97 sales is lower, and in terms of cost of sales, it should have been this number, but it is a lower number, so that is good. Okay, so we can work out for almost all. See, the variance occurs because of the fall in sales. Okay, sales should have been 1168, but it is only 1071. So because of that only the variance is like incurred. Okay, so this is a negative number. So if you add all the variances, not all, okay, at least these variances, you will get the total. So that's 48.125. So that's about the sum here. The concept is we have to find out this should have been, okay, the sales should have been this number, it is this number. The cost should have been this number, but it is this number. Okay, so in terms of sales, actual should be higher. In terms of cost, the cost should be lower, okay, than the budget, the flexed budget. Okay, so that's why we have changed the numbers like actual minus budget or budget minus actual. We have changed and worked out. But however you work out, you can get the logic of it perfectly. Ensure that you understand the logic of it so that you can get the answer perfectly. Okay, and if you want, you can mark it like this. This is adverse, this is favorable, 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 again favorable, favorable. This one is adverse, and this is adverse. Okay, so that's about the problem here. Hope you guys got a good understanding about flexible budgeting. We'll move on.